Welcome back. Another episode of Chalk Talks with Coach B. These next two episodes, I'm going to be talking about some of the market manipulation that takes place through the use of options, likely in the dark pool and almost surely by two colluding parties. Today, we're going to start by talking about deep in the money calls. And in my next video, we will cover married puts. If you're unfamiliar with how a call contract works, naked shorting, or even dark pools, please refer to some of my previous Chalk Talks that I will link below. As always, if you have any questions or ideas for a new topic, please leave them in the comments below. Also, hit the like and subscribe button to help support the channel. Okay, so deep in the money options. First thing you need to know is that options can be exercised at any time in the US, so you don't have to wait for the expiration. Second is that deep in the money call options typically don't hold a ton of intrinsic value. And what I mean by that is the premium you're paying is usually the difference between the strike price and the actual price of the stock, plus a little bit extra. Depending on the length of the contract, longer out will be worth more. Let me show you this on an option chain to hopefully make more sense. Okay, so right now I pulled up AMC. It's currently trading at $31. If we go all the way down to the $5 strike, which is right here, and this would be considered, basically about as deep in the money as you can go, right? We can see the actual cost of the premium is $26.30 plus the strike price is $5, which means you'd be paying $31.30 to buy this contract right now and exercise it immediately. $31.30. Well, with the stock trading at $31.10, you're basically paying about 20% or 20 cents in premium, right? So about $20. Now, so we'll consider that, let's say that 20 cents the fee in this regard. Now let's jump out a couple months. All right, so let's go down to, let's say, October. Again, we'll stay with the $5 strike. Stocks trading now at $31.17. It's moving while we're talking, but $26.50 plus the strike price would put you at $31.50, $31.65 now as we're talking. But basically, the difference there is about 40 cents. Okay, so by going all the way out to October, we're going to be paying a 40-cent fee or $40, considering that the contract is times 100. That fee will continue to increase the further out in the chain you go. And if you were to go less in the money, let's say at $10, that difference would be a little bit higher, and so on and so forth. But anyways, so now that we got that out of the way, here's where the manipulation takes place. You have two parties colluding with one another to short a stock down. It could be institutions, it could be hedge funds, it could be market makers, or a combination of any of those. For this example that I'm going to put out right now, just to help us understand, I'll use a hedge fund and a market maker. Let's say the hedge fund is massively short a stock and needs to get their hands on 1 million shares immediately. That could be to return borrowed shares, it could be to clear an FTD, a failure to deliver, or even to sell downwards into the market. Let's say it's a SSR day and, they can't aggressively short sell into the market, but if they own stock, they could do that. Either way. So it could be any of those reasons. But the hedge fund obviously doesn't want to buy those shares in the open market and drive the stock price up. So they'd like to do it on the dark pool. But there's no institution selling 1 million shares in the dark pool. Well, the hedge fund can entice a market maker to sell them those shares on the dark pool through the use of deep in the money options. Remember that fee I talked about. Because no one is actually selling 1 million shares on the dark pool, the market maker might be willing to take on a naked short position, basically selling the hedge fund those shares that don't exist for a fee, right? Okay. So depending on what fee they agree upon, now the hedge fund just needs to go deep into the money, buy deep in the money options from the market maker and exercise them immediately. So in my example I provided earlier, AMC at the October expiration, we had a $5 strike. The fee would have basically been about $40. Okay, give or take $40-$50. Now multiply that times 10,000 contracts. You're basically looking at, roughly what? $400,000. And I say 10,000 contracts because that would basically be what you would need to get to 1 million shares. So hedge fund is basically paying the market maker $400,000 to get their hands on 1 million shares without driving up the stock price. Market maker is accepting this payment, this $400,000, to basically take on the liability of 1 million phantom shares. And now the market maker can either go try to accumulate those shares at a lower price, like we talked about. I think we were saying AMC was trading at 31.11. So in this example, the market maker can now go in and try to accumulate those shares at 31, at 30, 29 as they drive the price down throughout the day. Or market maker can come up with a failure to deliver if they don't actually accumulate those shares today, right? And they get 35 days to come up with those shares down the road, hence kicking the can down the road. So that's it in a nutshell. Basically, ahead in this example, it was the hedge fund needs to get their hands on shares. There's no shares for sale in the dark pool, but they want to do it through the dark pool. So what do? They make an arrangement with someone who's selling the options at the same time and say, hey, I'll buy these options that, if you'll let me buy 10,000 option contracts from you right now and exercise them immediately. Basically they're transitioning the failure to delivers or whatever it may be, giving 1 million shares that don't exist to one party and transferring the liability of those FTDs to another party, but they're doing it for a fee. And that fee is what they're, that difference between the premium and the strike price in the options that they actually buy. That's it in a nutshell. One party's paying the other party a fee to take on the liability. If you're interested in following the breadcrumbs on a stock that you think is heavily manipulated, the first place to start in this instance, if you think this may be how they're doing it, is looking for high volume of calls being bought deep in the money and then disappearing the next day. And the reason I say that is without the volume to match, is that's how you know they were bought and exercised. So for instance, let's say all of a sudden you see some deep in the money calls come in, 4,000 contracts on a stock's trading at $50, and all of a sudden you see a bunch of $10 calls come in. Yeah, that could be somebody who wants to just ride the momentum of a stock. But if all of a sudden the next day those it's not showing up as open interest and those calls disappeared and there wasn't volume to back up that being sold. So again, let me back this up. When open interest shows up on an option chain, that means that's what the calls that actually exist there. In order for those calls to disappear, you would have to see volume that lines up with it. So now if you all of a sudden the next day see that the open interest disappeared, but there wasn't volume to show that those calls were sold, basically what happens is that means they got exercised in advance. And now I would say you're on to something. Now you can start looking into other things to see if it all lines up. That's it for this video. In the next one, I'll explain how this manipulation can also be achieved through the use of married puts. I'm also going to link some DD from Reddit where this exact method of deep in the money calls was investigated and pointed out in regard to GameStop by some Redditors that were doing great DD. As always, if you have questions or ideas for a future topic, please comment below. I'm just trying to break this stuff down and explain it as easily as possible for people who may be reading some of this stuff and not understanding quite the concept of how it works. If you're liking this stuff or you have ideas for other topics, leave it down in the comments. Hit the like and subscribe button to support the channel. Come check me out every day the market is open on my live stream, Talking Stonks with Coach B. I start a half hour before the market opens. Look forward to seeing you there. Have a great day.